Somewhere in America, right now, there is a grandmother sitting in a house she owns outright. No mortgage, no credit card balance, no monthly payment eating into her peace of mind. She raised 4 children on one income, never missed a bill, and still managed to tuck money away every single week. Ask her how she did it, and she will not mention a financial advisor. She will not pull out an investment app. She might pause, smile a little, and say something like, "We just kept track." That phrase sounds almost too simple to matter, but buried inside it is a system so effective, so quietly powerful, that when banks and credit card companies figured out it existed, they spent decades making sure the next generation never learned it. It was called the invisible ledger. Not a book, not an app, not a complicated spreadsheet locked inside a bank vault somewhere. It was a method, a mindset, a daily discipline practiced by ordinary working-class families across America in 1955. Housewives, factory workers, farmers, people who never had much but somehow always had enough. This is the story of what they knew, how they lived it, and exactly why it disappeared. And by the end of this, you are going to wonder why nobody ever taught you any of this. In 1955, the average American factory worker brought home somewhere around $75 a week. That was it. No side hustle, no second income in most households, no gig economy waiting to catch you if you fell. Just one paycheck, one family, and a list of bills that did not care whether you had a good month or a bad one. And yet, somehow, most of those families were not drowning. They owned their homes eventually, they kept their lights on, they fed their children without putting groceries on a credit card, mostly because the credit card as we know it today barely existed yet. The first general-purpose credit card, the Diners Club card, had only just appeared in 1950, and it was a novelty for businessmen at expensive restaurants, not something a factory worker's wife in Ohio was carrying in her purse. Money in 1955 was physical. It was real. You held it, you counted it, you felt it leave your hand when you spent it. There was no swipe, no tap, no buy now and figure it out later. If the cash was not in your wallet, the item stayed on the shelf. That was the entire system. Banking existed, of course, but the relationship most working-class families had with their local bank was narrow and careful. You deposited your paycheck. You saved in a passbook account that paid you modest interest. You borrowed only for a house or maybe a car, and even then you lost sleep over it until it was paid off. Debt was not a lifestyle, it was an emergency. The culture around money in that era was built on something modern finance barely acknowledges anymore: shame. Not the crushing kind, but the quiet, dignity-protecting kind. Owing money to someone meant you had not managed well enough. Families did not advertise what they had. They did not compete through consumption. The neighbor with the newest car was not admired, he was quietly pitied. This was the world the invisible ledger was born into. A world where every dollar was a small, serious decision, where financial awareness was not a skill you paid someone to teach you, it was something you learned at the kitchen table before you were old enough to understand what a budget even was. The system did not need a name back then. It was just called living right. Nobody invented it. Nobody sat down one afternoon and designed a system. It grew the way most genuinely useful things grow, quietly, out of necessity, passed from mother to daughter to neighbor, across back fences and church pews and grocery store aisles. By 1955, it was simply the way things were done in millions of American homes, so ordinary that nobody thought to write it down or give it a title. The invisible ledger was exactly what it sounds like, an accounting system that lived partly on paper and partly inside the human mind. It tracked every dollar that came into a household and every dollar that left, not through complicated spreadsheets or bank statements, but through a combination of physical cash management and an almost obsessive mental awareness of where money was at every moment. The women who ran it, and in the 1955 household it was almost always the women, were not accountants. They had not taken business courses, many had stopped their own education early to raise families, but they could tell you, without checking anything, exactly how much was left in the grocery budget on a Thursday afternoon, exactly when the electric bill was due, and exactly how many weeks of savings stood between their family and genuine crisis.
That is not luck. That is a skill, a serious one. The mental accounting piece of the invisible ledger was something psychologists would not even begin to study properly until decades later. These women were mentally categorizing money before economists had a name for the concept. The $20 set aside for rent was not the same $20 as the grocery money, even if both were sitting in the same drawer. In their minds, those dollars were already spoken for, already assigned, already gone to their purpose. Spending the rent money on something else did not feel like a financial decision. It felt like a moral failure. That emotional weight was not a burden. It was the entire point. When spending money costs you something emotionally, when you feel it, register it, attach it to real consequence, you spend less carelessly. You pause. You calculate. You ask whether this purchase is worth what it will cost somewhere else in the ledger. Modern banking removed that emotional friction entirely on purpose. The invisible ledger put it back, every single day.
Pick any Tuesday evening in 1955. Dinner is finished. The kids are doing homework or heading to bed. The kitchen table has been cleared, and a woman sits down with an envelope, a pencil, and whatever cash remains from last week's paycheck. This was not a budgeting session. Nobody called it that. It was just Tuesday. The kitchen table was the financial headquarters of the American working-class home, and what happened there every week was more disciplined than anything happening in most corporate offices at the time. No jargon, no software, no pie charts, just a woman who knew her numbers and refused to pretend otherwise. The envelope system was the physical backbone of the invisible ledger. On payday, cash got divided. Rent went into one envelope, groceries into another, utilities, coal or heating oil, doctor savings, church contribution, each category had its place, and once that envelope was loaded, the amount was fixed, non-negotiable, sacred almost. The grocery envelope was where the real precision happened. A woman managing $22 a week for food for a family of 5 was not guessing. She knew the price of a pound of ground beef at her local A&P. She knew which day the bread went on markdown. She knew that buying a whole chicken and using it across 4 meals cost less than buying individual cuts. This knowledge was not written anywhere. It lived in her head, updated constantly, as reliable as any spreadsheet you could build today. Utility tracking was equally meticulous. The electric bill from last February got compared to this February. If it was higher, something changed. Maybe the kids were leaving lights on. Maybe the iron was being used more. The cause got found and the behavior got corrected, not because someone was cheap, but because waste was simply not acceptable when every dollar had somewhere it already needed to go. Rent was always the first envelope filled. Not the mortgage payment, not the car, rent, because losing shelter was the one consequence nobody could recover from quickly. Everything else could be negotiated, delayed, or reduced. The landlord could not be negotiated with if you showed up empty-handed. And above all of this, every week, without fail, something went into savings. Even if it was $2, even if it was coins, it went in before anything optional was considered. The kitchen table method was not complicated. It was just consistent, week after week, year after year, until the habit became invisible, woven so deeply into daily life that it needed no reminder, no app notification, no motivational podcast to keep it going. It just ran, quietly, effectively, like a household that knew exactly where it stood. Nobody told these families to build an emergency fund. Dave Ramsey had not been born yet. There was no personal finance section at the bookstore, no YouTube channel walking you through the steps, no app calculating how many months of expenses you needed to survive a crisis. The concept of financial wellness as a product you could purchase did not exist. And yet, the coffee can on the top shelf of the pantry had $40 in it. The glass jar behind the flour had coins adding up to something real. The folded bills inside the winter coat pocket, the ones the kids did not know about, those were there too. Emergency savings in 1955 were not a financial strategy, they were a survival instinct. The families who lived through the Great Depression, and in 1955 those memories were only 20 years old, sharp and present and unhealed, those families understood in their bones what happened when there was no buffer. They had watched neighbors lose everything, not because they were irresponsible, but because one bad month hit with nothing behind it, one illness, one layoff, one broken-down furnace in January. The Raining Day Fund existed because rain was real, and it came without warning. The method was simple. Every week, before any optional spending happened, a small fixed amount disappeared into savings, not invested, not deposited in a bank account that required a trip downtown to access, hidden, nearby, physical, and untouchable, except in genuine emergency. What counted as a genuine emergency was strictly defined. A sudden medical bill? Yes. The kids wanting a new toy? Absolutely not. A broken water heater? Yes. A dress on sale that would not be on sale next month? Not a chance.
That discipline sounds harsh described plainly, but it created something modern financial planning still struggles to manufacture artificially: security. Real, felt, daily security. The knowledge that if something went wrong tomorrow, the family would not immediately collapse. Savings were never about getting rich. They were about not getting destroyed. The scale was small by any modern comparison, but the psychology was flawless, consistent, automatic, protected from impulse, and attached to a clear and serious purpose. That combination, small amounts, consistent habit, emotional protection, is exactly what most modern savings advice recommends today. The women at those kitchen tables figured it out without a single financial certification between them. If this is making you think about your own grandmother, your own kitchen table, your own family, and what they knew that somehow got lost, you are not alone. Thousands of people are rediscovering exactly this. Hit subscribe and stay with us, because what is coming next is the part the banks genuinely do not want discussed.
Here is the problem with a family that never borrows money. They are completely useless to a bank. Not in a cruel sense, just in a purely financial one. Banks in 1955, just like banks today, made their real money on interest, on the slow, steady percentage that accumulates when someone owes them money and makes payments over months or years. A family that paid cash for everything, kept their savings in a coffee can, and considered debt a personal failure, that family was not a customer. They were a ghost. And there were millions of them. The invisible ledger families were not trying to be anti-bank. They were not making a political statement. They simply had no use for borrowing because they had built their entire household system around never needing to. By the time a major purchase was necessary, a washing machine, a new stove, winter coats for the children, the money had already been set aside, a few dollars at a time over months of patient, deliberate saving. The installment plan existed in 1955. Stores offered it. Buy the refrigerator now, pay over 12 months. It was tempting, especially for families who did not have the full price in hand. But the women running the invisible ledger understood something that the installment plan advertisement never mentioned. The refrigerator that cost $180 cash cost considerably more than $180 when you paid over time. The extra amount was small each month. Across a year, it was real money, money that could have gone into the rainy day fund.
They did the math. They always did the math. Avoiding installment debt was not stubbornness, it was arithmetic. The broader conflict between saving culture and lending culture was not visible in 1955 because the lending culture had not won yet. Banks were still somewhat respected but somewhat distrusted institutions, places you used carefully, not places that ran your financial life.
The idea that a bank would eventually offer that let you buy things you could not afford and charge you 20% annually for the privilege would have seemed like something from a dark science fiction story. But that story was already being written. The families with the invisible ledger were standing between the banks and the profits those banks would eventually capture. Not through resistance, not through protest, just through the quiet daily discipline of knowing exactly where every dollar was.
It did not happen overnight. That is the part worth understanding. The invisible ledger did not vanish because people woke up one morning and decided financial discipline was no longer interesting. It eroded slowly, the way most genuinely useful habits erode, through convenience, through advertising, through a culture that gradually reframed thrift as limitation and spending as freedom. The late 1950s brought prosperity, real, wide American prosperity that felt earned after the Depression and the war and all those years of doing without. Factories were producing, wages were rising, the suburbs were being built, and families were filling them. For the first time in a generation, wanting things felt acceptable, even deserved. The credit card arrived into exactly this moment. Bank of America launched the Bank America card in 1958, the ancestor of what would eventually become Visa. Initially, it was regional, available only in California, mailed unsolicited to thousands of households. Within years, the model spread nationally. By the mid-1960s, the credit card was becoming a normal part of American life, not a novelty for businessmen, but a convenience for everyone. The advertising that accompanied it was brilliant and patient and deeply understood human psychology. It did not say, go into debt. It said, live better now. It did not say, borrow money you do not have. It said, you have earned this. It did not position the credit card as a financial product with a cost. It positioned it as a reward, a symbol of arrival, a sign that you were doing well enough to have options. The installment plan, which the invisible ledger families had politely declined for years, was suddenly invisible inside a small plastic card that felt like status. And the mental accounting, the careful, practiced, emotionally weighted awareness of where every dollar sat, began to fade. When money was physical, you felt it leave. When money became a number on a statement that arrived 30 days later, the feeling disappeared. The friction was gone. And without friction, the discipline that depended on it started to loosen. One generation stopped teaching the next the system, partly because prosperity made it seem unnecessary, partly because the credit card had made it feel old-fashioned. By 1975, the coffee can was mostly just a coffee can. The results did not show up immediately. They never do. Through the 1960s and into the 1970s, the transition felt like progress. Families had more things, homes were larger, cars were newer. The standard of living, by every visible measure, appeared to be rising. Nobody was stopping to ask whether the foundation underneath all of it was as solid as the foundation their parents had built. It was not. Consumer debt in the United States in 1955 was a fraction of what it would become. By 1980, credit card debt was climbing steadily. By 2000, it had become a permanent feature of household finances for tens of millions of American families. Not a temporary bridge to cover a specific purchase, but a revolving balance that never fully cleared, carrying an interest rate that compounded quietly every month. Living paycheck to paycheck, which the 1955 families had considered a warning sign requiring immediate correction, became simply normal. Not comfortable, not acceptable in any personal sense, but statistically normal. Half of American households today report that they could not cover a $400 unexpected expense without borrowing. That number would have been incomprehensible to the woman with the $40 in the coffee can. The savings rate collapsed in parallel. In the post-war era, Americans saved somewhere between 8 and 10% of their income consistently. By the mid-2000s, the personal savings rate had dropped below zero. Americans were, as a group, spending more than they earned, financing the gap with debt. Consumerism did not create this, but it made the gap feel normal, even aspirational. The family with the newer car and the bigger television and the expensive vacation was not displaying recklessness, they were displaying success. The culture had completely reversed the signal.
What the invisible ledger generation read as a warning, spending more than you have, the consumer culture rebranded as a lifestyle. The discipline did not disappear because it stopped working. It disappeared because the culture around it changed so completely that practicing it started to feel strange. A woman tracking every dollar in an envelope in 1985 was not being wise, she was being old-fashioned. The invisible ledger became invisible for the wrong reason. Not because people saw through it, because they stopped looking.
Yes. Without any hesitation, yes. Not despite the modern world, but precisely because of it. The problems the invisible ledger was built to solve, overspending, lack of emergency savings, unconscious consumption, debt that accumulates faster than you track it, those problems are not smaller today than they were in 1955. They are dramatically larger. The credit card that the post-war generation first encountered as a novelty has multiplied into a wallet full of high-interest products specifically engineered to make spending feel effortless and painless. The invisible ledger was built as the exact counterweight to that feeling. Applying it today does not require a dramatic lifestyle overhaul. It requires one thing the 1955 families had that most modern households have quietly lost: the daily habit of knowing where your money actually is. Start with the physical version first. Take 1 week spending money out of your account in cash. Divide it into envelopes or jars or labeled pouches, groceries, transportation, personal spending, whatever your real categories are. When a category is empty, it is empty. No card to bridge the gap. No, I'll catch up next week. Empty means done. Most people who try this for 30 days find the same thing. There is a category where money has been silently disappearing in amounts they never consciously approved, not because they are irresponsible, but because the friction was removed and nobody ever told them to put it back. The digital version is equally simple. A notes app on your phone, updated daily. What came in, what went out, what category it touched. 2 minutes, every day. No software required, no subscription, no algorithm deciding what your patterns mean. The emergency fund piece is non-negotiable, and the 1955 families understood why. Before any optional spending in a given week, something small goes into savings. Not what is left after spending, before spending. The order is the entire lesson. Real-world benefit is not theoretical. It is documented in the lives of everyone who has tried it. Less anxiety around money, fewer surprises, more actual control over a life that otherwise gets quietly controlled by lenders and subscription services and impulse purchases that vanish from memory before the statement arrives. The invisible ledger was never about wealth. It was never about denying yourself or living small or refusing to enjoy anything. It was about awareness. The simple, powerful, quietly radical act of knowing where your money is, all of it, all the time, before someone else quietly decides for you.
If this hit different than you expected, if somewhere in here you thought about your own spending and felt something shift, that is worth holding on to. Subscribe so you do not miss what is coming next. We go deep into the financial habits that built real stability before the credit industry convinced everyone that debt was just another lifestyle choice. And drop a comment below. Tell me one thing from this that you are actually going to try. I read every single one. Because the invisible ledger was never meant to stay invisible.